the world economy is once again on the edge of a trade war. Tensions that had simmered beneath the surface for months have erupted, sending ripples of anxiety through financial capitals from New York to Shanghai. Investors, business leaders, and everyday workers are bracing for what could be a seismic shift in the global economic landscape. Washington's latest move, tariffs of up to 100% on all Chinese imports, effective November, has reignited tensions and sent shockwaves through global markets. The announcement came suddenly, catching many off guard and triggering immediate sell-offs in stocks and commodities. For multinational corporations, the new tariffs mean a scramble to reassess supply chains and pricing strategies, while, for small businesses, the uncertainty is even more acute. This isn't just a continuation, it's a dramatic escalation, threatening to unravel decades of economic interdependence. The intricate web of trade, built over years of negotiation and cooperation, now faces the risk of being torn apart. Companies that once relied on predictable flows of goods and materials are now forced to navigate a landscape fraught with risk and volatility. The trigger? Beijing's new export controls on rare earth minerals, a direct response to US pressure. These minerals are essential for everything from smartphones to electric vehicles, and China's move has sent alarm bells ringing in industries worldwide. The message is clear: economic leverage is now a weapon, and both sides are willing to use it. The fragile truce from earlier this year is now a distant memory, replaced by a cycle of provocation and retaliation. Hopes for a negotiated settlement have faded, replaced by a sense of inevitability that the conflict will only deepen. Each new measure is met with a countermeasure, fueling a spiral that threatens to engulf not just the two countries, but the entire global economy. A 100% tariff is economic warfare, doubling the cost of Chinese goods overnight and putting immense pressure on American businesses and consumers. Retailers are already warning of higher prices on everything from electronics to clothing, while manufacturers face rising costs and shrinking margins. For many, the question is not if they will be affected, but how badly. With $420 billion in bilateral trade at stake, the entire relationship is in jeopardy. The sheer scale of economic exchange between the US and China means that any disruption has far-reaching consequences, touching industries, workers, and consumers around the world. The stakes have never been higher. The rhetoric from both sides has created deep uncertainty, making long-term planning nearly impossible. Companies are delaying investments, rethinking expansion plans, and in some cases, considering relocating operations altogether. The sense of unpredictability is palpable, and the fear of further escalation looms large. Businesses and policymakers are scrambling to assess the fallout as the world's two largest economies edge closer to a point of no return. The decisions made in the coming weeks will shape not just the future of US-China relations, but the direction of the global economy for years to come. As the stakes rise, the world watches, hoping for resolution, but preparing for the worst. The economic risks are severe, and the warning signs are becoming impossible to ignore. Across boardrooms and trading floors, anxiety is mounting as experts try to predict just how deep the damage could go. Leading analysts warn that this escalating trade conflict could trigger a shock on par with the COVID-19 crisis, disrupting supply chains, upending markets, and shaking consumer confidence. Oxford Economics projects that the combined impact of sweeping US tariffs and Chinese export controls could slash a full percentage point off US GDP growth, an enormous blow that would ripple through every sector of the economy. Inflation could surge into double digits, squeezing households and businesses alike. Everyday essentials would become more expensive, and families would feel the pinch at the checkout line and in their monthly budgets. The specter of stagflation, stagnant growth combined with high inflation, now looms over the economy, threatening to stall job creation and erode savings. Moody's Analytics echoes these concerns, warning that political brinkmanship and uncertainty could quickly translate into real economic pain for millions of Americans. From Wall Street to Main Street, the US is already grappling with the challenges of post-pandemic recovery, AI-driven job anxieties, and increasingly volatile markets. Many workers and businesses are still trying to regain their footing. Adding a full-scale trade war to this fragile mix could tip the economy into a full-blown crisis, with widespread layoffs, business closures, and a sharp drop in consumer spending. The interconnectedness of global finance means the shockwaves would be felt worldwide, affecting international markets, currencies, and the livelihoods of people far beyond US borders. This is a high-stakes gamble with the nation's economic well-being, and the decisions made now will shape the future for years to come. As uncertainty grows, the world is bracing for impact, hoping that leaders can find a way to steer clear of disaster. China's dominance over rare earth minerals is not just a matter of economic leverage, it's a powerful strategic tool in today's global landscape. With control over the vast majority of the world's supply, China holds an ace that can influence the outcome of international disputes and shape the future of entire industries. These 17 rare earth elements are the backbone of modern technology, essential for everything from electric vehicles and smartphones to advanced missile guidance systems and renewable energy infrastructure. China's newly announced export controls specifically target 7 of the most critical rare earths, tightening the flow of these resources to the rest of the world. These restrictions don't just apply to raw minerals, but also to any product containing them, exposing deep vulnerabilities in U.S. manufacturing and technology sectors. For years, the U.S. and its allies have recognized the risks of relying so heavily on a single supplier, especially one that's also a strategic rival. Yet, building alternative supply chains and developing new mining operations outside China is a slow, expensive, and technically challenging process. In the meantime, American industries remain exposed to any sudden disruption in the flow of rare earths, risking production halts and economic setbacks. The stakes extend far beyond economics. National security and technological leadership are now on the line. Advanced weapons systems, next-generation communications, and even the future of clean energy depend on a steady supply of these elements. A prolonged shortage could cripple U.S. defense production, delay critical innovation, and erode the military edge that America has long relied on. The consequences would ripple through every sector that depends on advanced technology, from aerospace to consumer electronics. China's move is a clear signal. This is no longer just a trade dispute, but a high-stakes strategic contest over the resources that will define the future. As trade tensions escalate, the world is watching to see how the U.S. will respond to this new era of resource competition. The U.S. must now confront a dangerous dependency it can no longer afford to ignore, and take urgent steps to secure its own supply of these critical materials. The race to secure the world's most vital resources is on, and the outcome will shape the balance of power for decades to come. Tariffs and rare earth controls are shaking global supply chains to their core. U.S. companies reliant on Chinese manufacturing now face soaring costs and potential shortages. Containerized imports from China make up 40% of U.S. inbound freight. A sharp drop would disrupt shipping worldwide. Ocean carriers may cancel voyages, causing chaos in logistics and volatile shipping rates. Businesses must urgently find new suppliers, but shifting production is slow, risky, and expensive. In the meantime, costs will rise, delays will mount, and some production lines may grind to a halt. The crisis exposes the fragility of just-in-time supply chains optimized for efficiency, not resilience. Diversification is now a necessity, but the transition will be long and disruptive. The era of single-source dependence is over. Financial markets have responded with alarm. Wall Street plunged after the tariff announcement, with the Dow dropping 800 points and tech stocks hit hardest. The rare earth sector saw wild swings. U.S. producers like MP Materials initially fell, but then surged as investors bet on long-term gains from supply realignment. Australian rare earth miners soared, with some stocks jumping over 40%. Even Chinese rare earth companies rallied, anticipating higher domestic prices and strategic importance. The market's reaction highlights both the risks and opportunities in this conflict. While most sectors face uncertainty and pain, a select few stand to benefit from the scramble for alternative supplies. The weaponization of critical resources is reshaping investment strategies. For now, volatility reigns as investors try to predict the next move. The stakes have never been higher. Businesses are moving from contingency plans to crisis mode. The focus has shifted from cost optimization to building resilience and redundancy. Diversifying suppliers across countries and regions is now essential, even if it's more expensive. Companies are mapping supply chains, classifying risks, and considering reshoring or friendshoring for critical inputs. Tools like bonded warehouses and foreign trade zones offer temporary relief from tariffs, but don't solve the underlying problem. These are stopgap measures in a strategic crisis. The global business model is being fundamentally rethought. Adaptation is no longer optional, it's a matter of survival. Beneath the bluster, high-stakes diplomacy is underway. The upcoming Trump-Xi summit in South Korea is a pivotal moment, either a step back from the brink or a plunge into deeper conflict. Both sides are posturing for leverage, the US with tariffs, China with rare earth controls. Each wants to enter negotiations from a position of strength. The outcome could mean rapid de-escalation or a worst-case scenario for the global economy. The world is watching, hoping for a diplomatic breakthrough. The balance of power is precarious. The next move will shape the future of global trade. The path ahead is uncertain, but one thing is clear. The US-China relationship has changed forever. Even if a truce is reached, the era of unchecked globalization is over. Businesses and governments are committed to building more resilient, diversified supply chains. Strategic decoupling, especially in technology and defense, is now inevitable. The goal isn't total separation, but reducing vulnerabilities and creating a more balanced global system. Navigating this new era will require both competition and cooperation. The crisis is a catalyst for a more realistic, resilient world order. The challenge now: build a framework that manages rivalry, but keeps the door open for diplomacy.